Hi, everybody. Welcome to the July 2026 Economic and Market Update presented by Commonwealth Financial Network. My name is Chris Fasciano, and I am Commonwealth's Chief Market Strategist. Despite the signing of a Memorandum of Understanding between the United States and Iran to end the war in the Middle East, and a further 20% decline in oil prices, June was a mixed month for stocks. Equity markets were dragged down by the Magnificent Seven stocks, which all closed lower on the month. However, the rest of the market was resilient as breadth improved. Given the sell-off in the large technology names, the Nasdaq and S&P 500 both closed lower in June. However, the Dow Jones Industrial Average and the small-cap Russell 2000 both rallied for the month. The equal-weighted S&P 500, which removes the impact of the size of the company from the index weighting, outperformed the market cap-weighted version by roughly 3%. Despite the volatility in the larger names, this broadening of the market is a good sign for investors. The market benefited from increasing earning expectations for corporate America. Analysts are now projecting approximately 22% year-over-year growth for the S&P 500 in the second quarter. While this raises the risk of disappointment, recent history suggests resilience. Over the past 5 quarters, companies have continued to deliver strong results despite policy and trade-related uncertainties. If earnings momentum continues, it should provide a foundation for markets over the longer term. In addition, 2026 full-year S&P 500 earnings estimates have moved up almost 9% since the end of February, prior to the start of military action in the Middle East. Equally as encouraging for investors is that the 493 non-Magnificent Seven stocks in the index are expected to grow 19% for the full year. Improving fundamentals is a key to a sustainable rally. Enthusiasm for the Memorandum of Understanding and lower oil prices outweighed a hawkish debut by new Federal Reserve Chairman Kevin Warsh at the June FOMC meeting for fixed income investors. U.S. bond indices were marginally higher over the month. Despite the positive return for bonds, yields on the short end of the Treasury curve moved higher as market participants now expect the Fed to raise rates by the end of the year. As a result, 2-year Treasury yields moved up 16 basis points, while the 10-year yield was basically unchanged and closed the month at 4.47%. Data over the course of the month continued to be supportive of solid economic growth. The May jobs data came in well above economist expectations, with 172,000 jobs created. This alone is a strong sign for the health of the labor market. But underscoring this point was that the March employment data was revised up by 29,000 to 214,000, and April saw another 64,000 jobs added to that month's total, bringing it to 179,000. That yields a 3-month average of 188,000 new jobs created, marking the highest level since March of 2024. All in all, this is good news for the consumer and the U.S. economy. Despite consumer confidence continuing to indicate concerns about the future weighing on sentiment, retail sales continue to show that they are willing to spend money. And since consumers make up 2/3 of economic activity, that is also an encouraging sign. The fly in the ointment remains inflation, which has moved higher due in large part from the effect of increased oil prices flowing through the system. The most recent readings showed consumer price inflation and producer price inflation exceeded 4% and 6% annually, respectively. And despite the recent drop in oil prices, Chairman Warsh made it clear that policymakers remain firmly focused on inflation. Warsh reiterated the Fed's commitment to its 2% inflation target and signaled little willingness to adjust policy based on recent declines in oil prices alone. If rates do rise, it could pressure markets. Fundamentals drive markets over the long term, and they remain relatively solid for now. Solid jobs growth, continued consumer spending, and strong earnings growth should lead to economic growth and further market appreciation. Uncertainty remains high, and further short-term volatility is possible. However, a diversified portfolio that matches long-term goals and risk tolerance remains the best path forward. That's it for this month's update. I'll be back next month to walk through whatever the markets throw our way. Take care, and thanks as always for watching.